This meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one renter at a time, back with Taylor from Life Goal Investments. How you doing, buddy?
Doing great. Thanks for having me every week. This is awesome.
I enjoy our conversations. I enjoy them not only for the wealth of knowledge, experience, excitement you bring, but also we have different opinions, which I think is very healthy for my experts to disagree with me. So we're going to talk about probably the largest disagreement you and I have. You ready?
Yeah, absolutely. Let's do it.
So let me set it up and then we will talk about it because I think there's levels to this thing. So I think again, not to put words in your mouth, so correct me if I'm wrong. You generally believe that the Fed is going to pause rate hikes sooner than I do. The reasons for that we can get into in a minute. And I think they're going to go longer and higher than you do. That's really where we disagree quite a bit, actually, if we were to compare each other. Is that fair?
Yeah. And this has been an ongoing debate with us for now since I started coming on your show a month, 2 months ago, something like that. Neither one of us have moved from our camps.
No,
we've been
not at all.
Where we started.
So it's funny. Jerome Powell came out. I think it was NPR the other day. You have a quote.
Yep.
And I think Jerome Powell is kind of coming around to the fact that, dude, I got to break this thing.
Yep.
We just got to break this thing. So why don't you share with it and then talk about what you're thinking because of it?
Yeah. So Dr. J, as I've been referring to him lately, because I'm also watching that Lakers series right now where Dr. J's on it a lot. Anyway, so he has now gone from yes, we're going to be able to perform a soft landing to we think we can perform a soft-ish landing.
Yeah.
And then his last quote was, I don't know, or a soft landing may be beyond our control at this point. And he has now said for the first time, and granted, he's known this for ages now, but he has now said we raised rates too slowly. We didn't raise rates early enough. And he had never come out and actually said that. And that was nice to get some admission of guilt there because inflation's rampant. Like there's no way around it.
Yeah. So again, if you're on my channel, you know that my view hasn't changed. Stagflation 2022, recession 2023. And a lot of that is because I think here's an interesting tidbit. I will now call CPI in the next report, which comes out in early June, will be 8.5% or up from 8.3.
So it's reverting back upwards because it went from 8.5 to 8.3 or 8.1.
Correct. No, 8.3. 8.1 was the call.
8.3.
8.3. Yeah. So I'm saying it's going up, which is going to shock everyone. And I will call it right now. He will raise 75 basis points in June because of a hot inflation read.
Woo. So to your point, I guess you can look at this and say oil's now moving back upwards.
Diesel,
which is, yep. Oh, diesel feels crazy. At one point, diesel, the disparity between the two is like $1.
Yeah.
And that doesn't make any sense whatsoever outside of just straight supply demand. And there was obviously a massive demand for that. But the cost to produce it is actually lower in a lot of cases. But anyway, back to oil prices are going higher right now, which I actually don't think that persists. I think that probably rolls over some. They're still scared of what's going on in the Eastern Bloc. But also I think that U.S. producers are going to start coming online, and we're starting to see that. So we are self-sufficient from an oil perspective. We should be able to handle this shock ourselves. So I think oil will cool. But your comment that you've been on for a while now is that wage growth is just persistent right now. And you don't think that turns over in any short period of time? No,
and actually I think it gets worse because what we have seen so far is we've seen the bottom tier, right? The low income retail, restaurant, whatever.
Right.
They got it first and they deserved it first. Now you have white collar who is standing around making 80, 85, 90, 100 going, what the hell? I can't go to this. I can't go to that. They're going to start asking for it. We have record job openings. We have an unemployment rate sub 4. We have unions sprouting up everywhere.
Oh yeah.
Wages
here in upstate New York, Starbucks is one of the early in Buffalo. Starbucks is one of the early unionizers.
So it's coming. I think wages. I do not see. I see inflation going up. I mean, I don't want to say it. I would love it to go down. I just don't see it.
So I disagree. I think we've peaked
Awesome.
at inflation. I think it's moving back downwards. And I think that your comment I'll disagree on as well. I don't think the white collar worker is going to get theirs.
Okay.
If they haven't gotten theirs yet, it's not coming because you're seeing corporate earnings slow. Corporate earnings slowing is the bottom line of corporations slowing.
Mhm.
And so they can give a little bit of a nudge to that lower end worker and have it be a high percentage and keep them really happy.
Sure.
But percentages on an equal basis at a higher level wage obviously means a lot more money and a lot more to the bottom line of those companies. So
Mhm.
I just don't think with the slowing earnings that we're seeing right now, you're going to see people be able to step in. The cost of inputs are going up for these companies.
Yeah.
They've been able to pass it through to the consumer. I don't think that lasts much longer. I don't think that lasts much longer at all because you're starting to see the pockets of the consumer get weaker and weaker, especially on the lower end.
Yeah, no, I see all of that. I just think I think all of that comes to head next year. I still
Fair. I think it comes earlier. I do not think, I think if he went 75 here, do I think it would be the worst thing ever from an economic standpoint? No, but I think the market reaction to it would be visceral.
Oh, absolutely.
Visceral reaction to a 75 basis point move.
Well, yeah, and again, they're very connected, right? If CPI goes from 8.3 to 7.9 or 7.8 or whatever the next call is, he doesn't do it, right? He stays on track.
Yeah.
But if inflation kicks him in his teeth and he's wrong again,
yep,
they don't have a choice. Because
I look at it this way. I think that they are more willing to have so granted, they understand they have to control inflation, but they're more willing to have inflation run a little hot than really disrupt the economic backdrop is my take on it.
See, that's where I disagree. That's
in GDP.
We're
on the opposite side of that.
Yeah.
Yep.
So I do want this is where I wanted to get this conversation because I, like you, I think there's at some point where the Fed relents, right? We have learned over time, again, given history, that if the stock market throws up 30%, the Fed backs away, a la 2018, right?
Yep.
And 2018 is the latest example. I believe if the market goes down 30%, and it's only roughly 10% from here, he doesn't do a thing. I think the only time Powell comes in and bails out Wall Street is at 50%.
Yeah, that's a massive move. So we just saw right now, as of last Friday, we saw the forward price to earnings ratio of the S&P 500 come through its 25-year average.
Correct.
So things are coming back towards normalcy right now. So can we see more downside from here? Absolutely, and I think we're likely to do so.
Well, let's talk about that.
The Fed's raising rates.
So all we've seen is multiples collapse. We haven't seen earnings cuts yet.
Yeah, they're starting to get squeezed a little bit, though. You're starting to see some of the forward projections come in a little lower than expectation. And I think that's showing some corporate slowing. I mean, Bernanke, so the prior Fed chair to Jay Powell was Ben Bernanke, as you know. But he was on this morning speaking with Andrew Ross Sorkin, and he said that the thing to watch out for is forward inflation expectations. So you can look at 5-year forward inflation expectations, and they came down recently from their high water mark. So they're sitting right about 2.5%. So the market's saying 5 years out from now, inflation will be at 2.5%. That's I know your thought process is that's pie in the sky thinking, right?
Well, 5 years from now, I have no opinion about 5 years from now. I'm saying it's not happening. I'm not saying it's not happening next year.
Oh yeah. No, it's not happening next year whatsoever. But yeah, I am in the camp, and I'll stand in the camp that I think they get probably 100 basis points more on Fed funds before this thing starts to really crack.
So they
that's not consensus.
Crack, no, that could be as soon as July. That should be as soon as July.
It should be as soon as July. Yeah, I think what'll happen is they'll start to crack the economy. Then you'll see corporate earnings start to fade a little bit. And at that point, they will pause. And during their pause, the unraveling will start to happen. And you'll start to see, again, us roll into recession. Now, my case of this recession is, kind of end of this year, beginning of next year, but with the pace of, or the lack of the pace of rate hikes that I expect means a weaker recession or not as bad of a recession as what you expect.
Yeah,
shallow is a better way of putting it.
Yeah, I expect us to run through this, get to the other side, and it's deep and dark and long and painful.
And you've seen, so we talk a lot about the stock market on here. The bond market has been brutal. This has been the worst start to the bond market since 1842. No, I didn't say 1942. I said 1842.
Yeah.
1842. And so it has been brutal. The Barclays Ag, which is essentially the S&P 500 for bonds, is down 10% for the year. which
Wow.
is miserable. For context, how bad that is, the last 20 years, for the entire year, the worst calendar year we had for bonds, the Barclays Ag was down 2%.
No,
We're down
5x.
10 right now.
Year to
in
date.
5 months.
Yeah.
In 5 months, exactly right. And so,
Oh, wow.
we talk a lot about bonds, just because part of what we run is a heavy fixed income exposure.
Sure.
The best time to invest in bonds is right after inflation peaks. Right after inflation peaks,
Yeah.
generally what happens is, and the reason this makes sense is inflation peaks because the Fed has to raise rates and force us into a recession. In a recession, what does well? Fixed income does well.
Exactly.
So the last 3 times we've had inflation peak, you've had double-digit returns for the subsequent 2 years. In 74 inflation peak, 75, 76, we averaged 10% for those 2 years. We did it again in 80, we averaged 20%. And then in 83 for a 2-year period, averaged 25%. This is
Wow.
in government bonds.
Yeah, that's nuts. Folks, this is why Taylor is part of the Weekly Expert. He brings a level of detail that I have no experience in. Need to check him out. Life Goal Investments. You want him to go to Instagram?
Instagram. Yeah, it's the best place. We put out daily content there. So at Life Goal Investments on Instagram is the best place to see us.
Check him out, folks. Thank you very much, buddy.
Thanks, Michael.